Hey guys, what's up? In this video I'm talking about why I'm changing my strategy. So am I changing from a 10 delta to a 30 delta to a 25 delta? Am I still trading credit spreads? What am I doing? Well, I'm going to walk you through exactly what it is I'm doing, what I've changed, and the exact rules and systems behind it so you can start trading exactly like me if you want to by the end of this video. So let's walk through why am I changing it and is it worth it to you to change too. Okay, for those who have been following me for a while, you know that I have an 85 or 84% average win rate and I'm collecting roughly 15 cents per trade. So this is what I typically do. So again, this means that one, I make $15 for every time I win, and I lose roughly, again, because I sell at 50 cents because that's what my stop loss is, then I get out at roughly 35 cents. So this is my stop loss. So I'm making 15 and risking 35 with an 84% win rate. This works out long term. How do I know that? Well, this long-term expectancy value, you simply take 84, the amount of times you win in a 100 trade period, 84 times winning 15 minus the amount of times you lose, so 16 times the amount you lose, which is 35, would give me $700. So now I have an expected return of $700. So this is the strategy I've been using. Now you may be wondering, Austin, how can you get an 84% win rate with all these strategies? Are you trying to make money with credit spreads, or just trying to understand my strategy, or trying to find a strategy that works in any market? Well, I put together a free course called the Ultimate Credit Spread System course. It walks you through how it works, every strategy for every different type of market, how to generate monthly income, the exit rules we use, the minimum credit, trade sizing, and all that. So if you're interested, click the description down below to get free access. Anyways, hope you enjoy the rest of this video. Well, simply this. You follow the trend. So this is a system that I've been using for the last 6 years of trading. I've been trading stocks for 5 years, options for almost a year now, of doing this. And trend following is amazing. Why? Because it's the idea of following the big money and big moves and big waves in the market. So for instance, you can see here, there's periods when the market's trending up, there's periods when it's trending down, there's periods when it's sideways and not necessarily knowing what it's doing. But you can see here the market takes cycles and waves. If you take advantage of these moves and trade in that direction, you can make a lot of money, increase your win rate, and do so more profitably and more consistently. So trend following is the underlying strategy. That is still the same. I'm not changing that. I'm changing the way I set up credit spreads. So this is the way I originally set up credit spreads. This is my expected value. So what am I doing now? Well, now I have roughly a 71% win rate. I'm collecting roughly 27 cents per trade. So that means that I am risking the same amount of my stop loss. So I'm risking $23. So just for easy sake, I am risking $1 to make $1 with this system. So that's going to be with a 70% win rate. That's going to equal what? This changes from 71% win rate, so 71 times the amount I win, which is 27, minus the amount I lose, which is more, so 29 times 23. That gives me a $1,250 long-term return. So you can see here, I'm almost doubling my expected return value. So what in the world does this mean? Well, it means that this is the most profitable strategy. But what else does it mean? It also means I'm going to lose way more often. So again, with this strategy, you can have like match drawdown, which means like the number of losers in a row is probably around 10. Well, the number of losers in a row with this strategy is going to be around 15 losers, maybe even more than that, maybe 18. So 15 to 18 losers in a row. So again, you are losing a less amount. You're only losing 23 cents per loss versus 35, but you will lose more often because your win rate's a lot less. However, because you're collecting almost double the amount you typically collect, that not only lowers the amount you lose, but it increases the amount you win. So that's why it is more profitable to use this strategy. Now again, we're still using the trend following aspect. So again, this is the math, the expected value behind why I'm changing the credit spread that I'm taking. However, the entry criteria, the rules that we use is all saying the exact same. So let me walk you through that so you can actually start to implement it for yourself. First off, there's a course down in the description below that explains it all in depth, but I'll give you a quick overview. Number one, assess which direction the stock is going. So looking at the S&P 500, if it's above this line, the 50-period moving average, then we're trending up. If it's trending up, we're going to use a put credit spread. If it's below, it's trending down, we're going to use a call credit spread. So right now it's above, so we're going to use a put credit spread. We look at the close price. So right now the current close price on this stock or trading price is 448. So we're going to go 448, and we're going to go 1% away. So 0.99. then we're going to round to the nearest whole number. So this gives us 443.52. Rounding to the nearest whole number, that's 444. So that means that we're going to take, to get our strike price, we're going to take the close times 0.99, and that will give us our short strike. So in this instance, 444. And then we're going to buy the next one below, so 443. This is how we set up the strike price. Okay, expiration date. How do we figure that out? Well, it's quite simple. We're going to take the current date. We're going to add 7 days, and then we're going to round to the next Friday. So for instance, today is September 6th. So that means adding 7 days, that becomes September 13th, which is a Wednesday. So we're going to actually bring that to the next Friday, so September 15th. So September 15th in this instance would be the expiration date that we pick for this trade. Cool. Okay, next, how much credit are we collecting? Oops, I'm touching my face now. Credit. How much credit do we collect? Well, quite simply, all we need to collect is at least $1 risk, $1 return. So that means we need to collect 25 cents plus. So if we can collect 25 cents or more, we are absolutely golden, and we're going to make a lot of money with this strategy. Here are the 3 rules and setups to do to have a profitable trade, to trade this and have an expected return of $2,500. Again, what are the rules? You want to make sure that you're placing 2 trades a week, and if you can do that with these exact setups and criteria, you will be able to make money long term. If you want to learn exactly how I do this, again, there's a free course link down below. But anyways, you can also subscribe, because this channel gives you ways to make money as a credit spread trader, rules, edges, and things that you can use to actually start applying today, unlike other channels that talk about theory and fake stuff. Anyways, guys, see you in the next video.